Welcome to A Canadian Investing in the U.S., a podcast and YouTube channel focused on Canadians buying real estate with host Glenn Sutherland.
Welcome to a new episode of A Canadian Investing in the U.S. This week, my guest is Matt Shields. Matt, if you want to give everybody a bit of an intro to yourself, and we'll get into it.
Yeah, so we invest in large multifamily properties. We've got properties in Ohio, Georgia, and Texas right now. And we've been doing that for probably about 5 or 6 years now. We've grown pretty quickly. So
that's awesome. That's awesome.
Do you want me to just kind of jump into things, or do you have?
Sure. Yeah, I'm informal. Like I'm just having a conversation. That's why you're probably like, you didn't plan nothing.
No, I love it. I love it. That's the same way I do my podcast too. Just whatever topics come up, Okay, so with obviously, there's been more wealth generated by real estate or with real estate than pretty well any other vehicle, right? And depending on what it is that you're looking for, there's a lot of benefits to it. I've got some other companies. I've got a technology company as well.
Yep.
And, part of it sort of cycles through and feeds one another where, the technology company is doing well. I can invest that into the multifamily opportunities, which then that money will grow on its own. And I also get depreciation for the technology company, right? So great avenue if you have other sources of income to be able to, just roll those profits over and be able to generate write-offs through the depreciation in the various different assets. Does that make sense?
Yeah, maybe go into a little bit about how you get the depreciation, because I'm not perfectly 100% clear on how you get it on your tech company. I get it on real estate.
Yep. So the tech company basically will invest into the property, right? So it's got its own accounts.
They're going to get the depreciation credit from
exactly. Yeah. So when we do like a cost segregation study, it gets whatever the percentage is that it's invested in. So it's a way to be able to take that cash that would normally just be sitting there, or maybe if you don't need to reinvest it into the company or anything like that, this is a way to be able to, again, invest it into something else. It grows for you. And then, again, you get the depreciation or the write-offs, deductions, however you want to look at that, through that investment. So
yeah, and that's also cool because you're running the both businesses, so you can set that up. I know some syndicators they give you. Honestly, if I was going to invest, I'd be looking for one that does give depreciation credits. Some of them keep them to themselves.
Yep. Yep.
So,
yeah, we always do cost segregation studies, and it's great. That first year, if you can get all of the work done, or a good chunk of the work done, the capex that you're going to put into that property, you get 100% of that back basically. So I think the second year is 80% of whatever you put into the property. So it kind of diminishes from there. But yeah, we always share that with the investors with whatever however much they've invested into the property, then that's what they get the percentage of the depreciation for.
I've had a bunch of syndicators on here. Maybe I'll do a little bit of backstory. And some of them are just buying the properties that, you or I would renovate. And then, when we sell them at the end, they're buying the end product. And I don't see how there's anything left in that. So if you were an investor and you're trying to choose your syndicator, what kind of things you'd be looking for?
Yeah. So the way that we do things, because I feel like we are answering our solution kind of answers that question the way that we look for things, right? So we always like to under promise and over deliver. So one of the things that you should look out for is someone who is claiming that they're going to have a 25% IRR, right? That sounds like a great return, but at the same time, they might be stretching to be able to achieve those returns. And, I'm not saying that that's not possible, but don't buy into the fact that, like, don't pass over another opportunity to be able to go into an opportunity that someone is claiming that they're going to make, 25%, because there's a good chance that they're probably going to miss that too. Right. So if it looks too good to be true, chances are it probably is. But again, there are opportunities out there that you can do that and much more, in real estate as well. So you kind of want to go through and look at, the deal itself. I would say that doing your own due diligence on the comps that they are looking at is very, very important as well. So, and that's just like anything else where you want to find other properties in that general area that include elements of the business plan, right? So, you mentioned a lot of people were going through and already or buying the properties that have already been improved. So you would want to go and look at all of the units or the buildings in that area that have already been improved, and what are they getting for rent? And one of the secrets that a lot of people like to glance over is people will say, we have a 2-bedroom apartment. We're going to ask $1,200 for it, right? Oh, but I see over here they've got a 2-bedroom apartment and they're asking $1,600. So we should be able to get $1,600, right? And that's kind of the thought process that a lot of people will go through. Yeah. But what you need to look at is calculate out what the price per square foot is, right? Which kind of gets back to our podcast as well. It all revolves around that price per square foot and what you can get for that price per square foot, right? So we've been in situations, or we've seen situations where someone was expecting that they were going to be able to get, again, just throwing a number out, $1,500 a month, because that's what the comps are, that's what the other 2 bedrooms are. But then the 2 bedrooms that are actually in that property are very, very much small, very much more smaller than the comp property, right? So then that obviously limits your ability to be able to increase those rents to what you're expecting to, which then obviously, gets into all the returns and all of that. So you want to be very mindful of what they are anticipating getting on a price per square foot, and then, making sure that that matches up with the area, the area pricing. So, so those are a couple of things, and again, for us, whenever we're looking at other partnerships or anything, we want to be able to understand the people behind the opportunity as well. Have they gone through some adversity? Have they, have things blown up on them, right? If you haven't had anything blow up on you, either you're not pushing hard enough, or you're being too conservative. But things are going to happen, right? It's not always going to be roses and clouds that are going to unfold with these properties. So you want to make sure that people have gone through those types of situations and led the team to be able to, make sure that they see that project through on the other side, rather than, oh, sorry guys, we can't do anything here, right? So
yeah, no, that just reminded me of like doing, like, when you're hiring property managers, the same thing. Like if I'm getting a referral from somebody and they're just like, yeah, no, that everything's been perfect, and you're like, well, that doesn't do anything for me. That means they may not have had anything to do. Like, I want to hear some adversity. I want to hear them solving problems. I want to, because that's what this is. That's this business is solving problems, right? It's not, it's buying properties properly too, right? But a lot of it's solving problems.
Yeah, exactly. And it's amazing, especially on the property management side of things. So we actually have our own property management company and our own construction company. So we, kind of cycle through and do all that work ourselves. But the number of things that have come up throughout the course of our career, it's unreal. Some of the situations that present themselves when you're dealing with tenants and all of that. I mean, there's just no way to be able to project everything that's going to happen. Roadblocks, issues, hurdles. Yeah, it's all over the place. So,
yeah. And like, when we were talking, like just a minute ago, when we were talking about like, things to look for in a syndicator too, is if you're looking at their underwriting, what I want to see is that they're doing some sort of value add to this. Like why is it getting pushed up in value besides just the market? Yep. Especially in this market. I know Texas, you mentioned you do Texas, and it's still a really strong market even through a recession. But I don't want them to be relying on the appreciation to be able to sell it for what and get us our 20 or 25%, or whatever they've mentioned, right? I want to make sure that there's something there's a a cause for the result that's going to happen.
Yep.
Hello, everybody. Thanks for listening to the podcast. I just wanted to let you know that I've created a new coaching program. I believe the new coaching program has way more value than any of the programs that have even existed in the past. What we've done is pre-recorded all the lessons so that you can work through it at your own pace, which is pretty cool. And then we're going to meet up on a regular basis to answer the questions, do deal analysis, and actually spend our time together working on things instead of spending our time learning things. I think this will make a seamless transition to buying in the United States and will help you solve a lot of your problems. If this is of interest to you, go to glensutherland.com/coaching. I hope to help you guys invest in the United States, and I hope we provide as much value as possible. Back to the podcast.
Yep. Yeah. Couldn't agree more. And again, that's kind of where, depending on what the strategy is there when they're purchasing it, we do this exact same thing where we only purchase assets that need that work so that, to your point, you obviously have that, that delta there between where the rents are and where they can be, once you do those improvements. So yeah, again, and having a team that has experience in construction, obviously, and managing or running those types of projects, whether that be the actual syndicator or if that's another team that the syndicator is partnered with, you want to make sure that there is someone there that has that experience to be able to pull that off. Because we've actually gone behind and purchased assets after, someone who thought that they knew construction or thought that they knew what they were going to do or how to manage that project, basically destroyed the project. And then we came in and, were able to, make an opportunity out of that situation. So.
Yeah. And you mentioned a minute ago that you have your own property management and construction companies. When you're starting that, did you buy a company to start with, or you built that right from scratch?
So we built both of them from scratch. I have a background in construction as well. I used to be an electrical contractor for about 10 years or so. I've probably been in the trades for, 15, 17 years, something like that. So, that made perfect sense, for us. And we pretty well will just partner with other construction companies for the most part in the various different cities that we go into, right? So we're still managing that process. We do have project managers and all of that manage the project, but we don't necessarily we have a few like people that can go in and do some of the work, but typically our crews are not the ones going in and doing the work itself. We're just more or less managing that particular construction project.
Okay. So you're kind of so you don't have, I'm just trying to get my head wrapped around that. That's interesting. So you basically manage the contractors and you just get hire subs in each spot, or you hire like a contracting company?
Normally we've done it both ways. So it depends on how many subs we have in an area. Sometimes we'll just hire the GC that we're then essentially managing the GC there as well. So both ways.
Okay. No, I like it. And then I think you kind of just answered my question. What I was going to ask you was, Ohio, Georgia, Texas, you say you have your own property manager and construction company. So you have to really set up like 3 different teams, one for each one, or can you have like a project manager or whatever manage these from one location to all those 3 different locations?
Yeah. So we are completely remote, more or less. I'm actually in the headquarter office right now, and the office is pretty well, we can fit 3 desks in here or so, but I'm pretty well the only one that ever comes here. So everything is done remotely. My partners in Atlanta, pretty well the reason why we got started between Georgia and Cleveland, or Georgia and Ohio, is because I'm in Cleveland, my partner's in Atlanta. So we started growing from there, and then we had some opportunities present themselves in Houston. So that's kind of how the genesis, I guess you can say, of those operations has grown. And obviously, as we get into new cities, we start bringing on, various different staff members. So sometimes if one property needs a little bit more help, maybe the maintenance guy from one of the properties will go over and help manage some things on the other property. So it's not like it's, a complete new team across the board, unless, we're just getting into that area.
Yeah. And so like, it makes sense. And, having a guy in Georgia and you being in Ohio, you can go, should you need to, even though you say you're like a remote business, like you could go on site, right? A lot of these.
Oh yeah. And yeah, I should say that it's not like we never go on site, right? We're on site. Somebody's on site probably at least once a month. And again, depending on what the situations are, what's going on, could be multiple times a month. I'm just saying that we don't necessarily, we're not in each city every single day and, managing the projects in that particular city. We've got people that manage the various different stages from all over the place. So the property management team obviously is on site every day. And then, we help manage them through the property management company. So,
yeah. So for like a lot of people who listen to this, they're Canadians, or actually a lot of people when I look at like Apple and stuff where people are listening to is a lot of northern states as well. So to relate, I'm thinking the Texas projects are probably the most relatable because you're not in the same city at all. So how often do you have to travel over to Texas, or do you even have to go there, or you just go there to shake hands and kiss babies?
So myself, again, I probably go maybe once a quarter or so.
Okay.
But someone from the team, again, that one's under construction. So someone from the construction team will be there at least once a month. And again, depending what is going on, it could be a couple of times a month, right?
Okay.
So, but with that, we have multiple Zoom meetings, throughout the week, and we have, project update meetings all the time. I mean, that's what I basically do pretty well most of the day is, drive those meetings and make sure that everybody has what they need to be able to, complete their work. Right. So.
Yeah. And you just said construction, like you talking like ground up or renovation, like
So we haven't done any ground up construction. We actually have an opportunity right now to do like I think it's 28 unit condo development in a suburb of Atlanta. So that'll be the first new construction that we've done. Everything we've done previous to that has been renovation type work, and the assets have gone. I think the oldest assets we have are probably 1950 or so. We have some, pretty old ones in some great areas. To the newest one, I think the newest one is probably 95 or so. So, all throughout that area.
So if you're doing like basically renovation construction on that property down in Texas, I assume you're using a lender as well. Is there like a occupancy level you have to keep throughout this? Because it's just always the complicated part, because you just want to empty the place out to do the renovation.
Yeah. So we've been in various different situations. And again, it really depends on where the property is when you originally take it over, right? We had one property that it was actually 6 different buildings that were not continuous, right? So this isn't just one community. It was, different buildings all, within a half mile of each other, right? 3 of those buildings were pretty low occupancy, like in the 70s or so. The other ones were 85, 90, something like that. We had the lender tell us that you have to get those 3 properties up to 90% before we're going to give you anything more, in the CapEx dollars, right? So we had to go from, and I believe if I remember correctly, the hurdle or the number that they gave us was $800,000. So we basically had $800,000 that that was a $3.8 million construction project, renovation project. So we had $800,000 to put into 3 different properties to be able to bring them up to 90% occupancy before the bank would allow us to take any more than that $800,000, right? So this was like a huge puzzle, being able to figure out, what is it that we do to be able to, get these 3 buildings up to 90% occupancy. And mind you, the bank didn't walk through 100% of these units.
No.
To this day, still don't know how the heck they they arrived at the $800,000 mark, but that was the mark. And we had to figure out how to make that happen. So fortunately we were able to do it. And once we got up to that, it wasn't an issue. But to answer your question, it really depends on the lender. Some lenders are a little bit more restrictive. Some lenders are a little bit more, willing to let you go forward with things. All of the lenders will basically, the process is you'll submit, we need this money for these projects, right? And if those are projects that are just getting started, sometimes the bank will give you a little bit of money, 50% down, whatever it is, to be able to start a project. We've also had banks say, no, we only reimburse you. So we basically have to fund the project first to get it going. And then we're essentially playing catch up where we're always getting the money back, right? But the banks will always require that request, the draw request, and then they'll send out a inspector to be able to verify, validate that you actually did what it was that you said that you did, right? So we've had situations too where, the banks, again, there's all kinds of situations that happen, but we had one situation where the bank knew that we had like 92 units that we had to renovate. So they had the total amount that we were going to be putting inside of the units. They had that total amount, and they split the amount out equally across all of the different apartments. But that wasn't the way that the project was going to go. And we never had this conversation with them prior to starting it, right? So there were some units that needed more money than other ones. And when we went and got the draw, we requested, I don't remember what the number was, but just say, $500,000 we requested. Yeah. And they came back and said, no, you're only 20%, or I think it was like 5% of the way done with these projects, based on investing the same amount into each one of the units. But we started on the more expensive units first. So the problem that created was we were expecting to get the $500,000. We only got like 120 of it, I think, something like that, which we've got all of these vendors that we have to pay, all of these contractors that have to get paid. And the bank will only do a draw request. Essentially, the quickest that they could fund it was like 3 weeks. So, we had to figure out how to keep everybody satisfied for 3 weeks, because we didn't want the project to stop, but because the bank didn't necessarily understand that we're putting more into, certain units, less into other units. It's not split equally. It completely changed, the draw schedule and the payment schedule. So it was an interesting learning experience, but that's what this is all about is, you go through, you learn, and okay, we're not going to make that mistake next time. So
is that what is that the takeaway is? If you're going to do it again, start with the easier ones, get a whole bunch of them like fully done, fully rented, hit your occupancy level, be able to do bigger pulls.
Yeah. Well, so the way we're very process orientated, right? So we now have a unit tracker that basically we lay all of this plan out and we share all of that with the lenders. So that way, again, it just keeps everybody on the same page. Whereas before that, we weren't sharing. Other lenders hadn't asked for that before, but it makes sense how this could present itself. So rather than going down the road, maybe the next lender doesn't require it or doesn't need it, but the next one might. So our process is now to make sure that we're including that unit tracker with, budgets on a per unit basis. So that way, again, there's no questions moving forward. So we've basically solved that issue because of the learning that we've gone through. And that's what you keep doing with this is, as you experience something, as something blows up in your face, those things that don't go right, like what we started this with, you want to learn from those and adjust to them and put processes, systems in place so that if 6 months from now you're in the exact same situation again, it doesn't blow up in your face again. So
that's great advice. Love it. Good stuff. Well, guess we're getting to the 20-minute mark. Matt, people wanted to track you down, wanted to pick your brain, invest with you, whatever listen to your podcasts, like how do they find you?
Yeah, so I'm pretty active on LinkedIn, which it's just Matthew Shields, and then the podcast, which is probably the best thing to keep up with what we're doing, what types of projects we're in. And there's all kinds of learning on there too for other entrepreneurs, and pretty well anybody in business is going to be able to learn something from it. That is Invest in Square Feet. So just go to investinsquarefeet.com. And of course, it's on all of the various different platforms that wherever you listen to podcasts at as well. So
I had to ask you, what Square Feet? You want to explain the name?
Yeah. So again, it gets back to how important it is to break it down to understand that project and invest in. You are making an investment into the square feet. So is that feet valuable, or is that square foot valuable? How valuable is it? What is the
Like
highest and best use
for doing construction and stuff?
Exactly.
For whatever reason in my head, I was picturing like physically like square feet.
Yeah. Yep. No, it's interesting because a lot of people do that, and the name starts to generate conversation in itself as well, right? What does that mean? And then when you explain it, oh, that makes sense, and that's a great way to look at it, right? But again, it should all come back down to square feet. Make sure that you're comparing the same square foot to the same square feet to be able to make sure that your investment's going to be able to pay off. So.
Awesome. Well, Matt, thanks for coming on the show. I really appreciate it. I think there's lots of stuff for people here. So that was great.
Love it. Excellent. Thanks, Glenn. Thanks for having me.